All right, in the second part of the discussion of Chapter 2, we're going to look specifically at uh, balance sheet. So I want to go to the balance sheet data. Let me close out the table of contents here. So this is balance sheet data for Sage Inc., and it is for their year ending December 31st. So they've got 2015 and 2016 data, which is typical of the presentation of balance sheet data. The amounts in here are reported in thousands. So that means that you would have to add 3 additional zeros after this to come up with the correct number. And so when you're looking at under current assets and you see cash and cash equivalents, that would be 9,333,000, not 9,333. So you just need to remember that when you are using this kind of data. Notice with accounts receivable, less the allowance for doubtful accounts, so they report accounts receivable as net, and they could just say that. Here they tell us that we have $448 in 2016 and $417 in 2015 for the allowance for doubtful accounts. That's actually a pretty consistent number given the balances. And that's one thing you're going to want to do when you analyze it. When we get into the problem for analyzing accounts receivable, we will talk about that, because this $8,960 or $8,960,000 in accounts receivable is the gross amount less the allowance. So that means that if you take the 8,960 and add 448 to it, that was the gross amount of the receivables for the period. And so we'll get into why that's important, why you want to use that information later. Inventories, remember right here it just says inventories and we have dollar amounts for them. So we know the valuation in terms of the dollar amounts, but we don't know the method of valuation. We don't know if they use LIFO, FIFO, or average cost, or some other method. And so, again, you would have to dip into the notes to be able to determine how they value their inventory. Then you've got prepaid expenses and other assets, and then your total current assets for the period. Then down here, they're non-current. They don't list them as non-current. It's a different heading. Notice how they use the indentations here so that you know that this is a major header because it is italicized. Here, this is a subheading, current assets, under assets, and then plant, property, and equipment is a heading under assets. And so these are your longer term assets: land, which typically doesn't depreciate; buildings and leasehold improvements, which do depreciate; and then equipment, which also depreciates. And then here they've said less accumulated depreciation and amortization. So what they're doing here is they're saying, okay, these are the gross amounts. Then this is all of the accumulated depreciation and amortization. And so these are the net amounts of property, plant, and equipment. They could have just as easily just reported the net property, plant, and equipment as a single line item or 3 line items. You'll see it reported in a lot of different ways by companies. So in this particular instance, they've given you a lot of information in the financial statement itself. But again, if you want to know more, you need to go back to the notes to the financial statements. And then we have goodwill, which is an intangible asset. And then other assets, and that could be anything. If you want to know what they are, again, you're going to need to go back into the notes. And the spring semester class actually had to do that. They had a case they had to work through. It ended up being a very difficult case, a very challenging case, and I was happy with the results. I think a lot of people did a pretty good job of it. But you had to go in and figure out, okay, what are the other assets? Because they may or may not be important. You just don't know. And then again, you come down and you see your liabilities and stockholders' equity. And so they show us our current liabilities. So they have accounts payable, accrued liabilities. Again, accrued liabilities, that is what accounts payable is. It's just they separate it out because look at the volume of accounts payable versus the rest of the accrued liabilities that they have. So accounts payable is their primary current liability. And then the income taxes payable, that's something that companies leave segregated because folks are interested in both the income tax expense and the income taxes payable. And there's a reason for that, and there is an explanation for why it's important, and I don't want to get into it quite yet. Then they have short-term debt, which is what's due within the current year. So that gives us our total current liabilities. And I don't want to forget, I told you about the current maturities of long-term debt, and they do point that out to you there. They have that line item, and they show you the current portions that are due. Then we have something called deferred federal income taxes. And again, that relates back to income taxes payable and income taxes expense. And that could either be a liability or an asset. If it's deferred income taxes payable, meaning that it's something that you're going to owe, then it's a liability. If it's a benefit that you're going to accrue in the future, that would show up as an asset. And then you've got your long-term debt. And then any commitments and contingencies that might exist, they don't have any amounts reported, but they direct you to see notes 3 and 5. And that's because on commitments and contingencies, there could be some items that could have an impact on the company, but it's not sure enough that they can actually record it in the accounting system and report it in the balance sheet. And so then you have your total liabilities. Then down in the equity section, you see your common stock. Again, there's typically going to be a par or stated value. In this case, it's 1 penny. And so they have 10 million shares. They have issued 4,363,000 shares in 2016 and 4,355,000 shares in 2015, and then additional paid in capital. So all of that is being lumped together in that single line item. And so if you want to break it out, you're going to have to go into the notes. Sometimes companies will break it out for you. And then the retained earnings. And remember, your retained earnings are not the same thing as cash, but it is a historical account. What they're recording in retained earnings is the history of net income and, God forbid, net loss over time. If it's net income, it'll be credited into the account. If it's net loss, it'll be debited into the account. The other thing that comes out of retained earnings is when the company declares and pays dividends. Dividends will come out of retained earnings, so that would be a debit to the retained earnings account. Typically, again, to pay dividends, you need not only have positive retained earnings, but you must also have the cash on hand to be able to pay them. There are other forms of dividends. We're not going to get into that discussion right now. But just understand that that is what retained earnings is. And that's why you have to look at both the retained earnings balance and the cash balance when you are going to determine whether to pay dividends or not. Dividend policies are really important to companies. Companies will also maintain policies on long-term debt. So that's not unusual. Unfortunately, for private companies, you won't necessarily know what those are. But for governmental, that you can actually look up and find online at the government websites. So let me see, what else do we have here? So again, this is a comparative balance sheet because they're giving you 2 years, and that is very typical. I believe what they typically do is give you 2 years of balance sheet data and 3 years of income statement data, and that allows you to do a complete analysis using both the balance sheet years. Again, the balance sheet is 1 year at a time, and so that's just for the activity as of December 31st, 2016 and as of December 31st, 2015. Okay, the income statement data, when we look at that in Chapter 3, income statement data is a period, so it covers an entire period. So it would be from January 1st of 2015 to December 31st of January 2015. Same thing for 2016, January 1st of 2016 to December 31st of 2016. So the balance sheet is at a point in time, and the income statement is for a period of time. So that's important to keep in mind. Your goal should be that you're comfortable reading this and understanding this. The other thing that you need to be comfortable with, and I don't think we can do that here, is to be able to go back and look at the notes. One last thing I want to go over in this video is what is a common size balance sheet. And a common size balance sheet is essentially where you're going to display the balance sheet as percentages. And when you say percentages, you're like, well, a percentage of what? Well, in this case, it's total assets. So when we come over here, they are showing 5 years of common size balance sheet information. And this is important for analysis. It doesn't give us the raw dollar amounts. This tells us everything in relation to total assets. So total assets is going to be 100%. Okay, everything else will be expressed as a percentage of that. So of that 100%, 69.1% of it is current assets. The balance of it is going to be non-current assets. Okay, so it's 30.9% that will end up being, and then the bulk of that shows up as net property, plant, and equipment, 30.5%. And again, when you start to dive into it, you can look at it and see, okay, equipment makes up 22.6%, and then buildings and leasehold improvements at 19.2%. And you might ask, well, why are they doing it as a percentage of total assets? Well, remember the formula, assets equals liabilities plus equity. So actually what you're looking at is, when you're looking at this, buildings and leasehold improvements are 19.2% of what? Well, they're also 19.2%. If you were to look at it, it's of assets. If you come down here and look at accounts payable, it says 15%. Well, your book still says it's of total assets. And so does that really make sense for comparative purposes? Well, sure. But it's also 15% of this down here, total liabilities plus stockholders' equity. And so you can look at total current assets and say it's 28.8%. You calculate it as a percentage of total assets, but really it's 28.8% of total liabilities and total stockholders' equity. And again, there's no hard and fast rules on this. You just have to define what it is you're doing. So for your analysis purposes, you may want to know what each of the current liabilities are relative to the other current liabilities. You can calculate that percentage. You can calculate it for just the liabilities, both the current and the long-term liabilities, and leave equity out of the equation. There are certain things that have to be reported in a 10K and in an annual report, but in terms of, for analytic purposes, for making decisions, you can divide this up and report it any way you want, as long as it makes mathematical and logical sense to do so. All right, so hopefully you guys understand that. So again, how would you do this? So let's look at 2016 for cash and cash equivalents. If we go back up here to the actual balance sheet, the amount they reported was $9,333. And so if I was to look for, let me see if I can find my handy dandy calculator here. Give me uno momento. I think it's going to show up where? Accessories. And give me a second here. Calculator. Okay, there we go. So we have 9,333, and then our total assets are, boom. So let me go back. We're going to divide it by 95,298 equals. And so we get 0.0979, which is 0.098, which when you multiply by 100 to turn it into a percent, it becomes 9.8%. And so when we come down to here, we see that cash and cash equivalents for 2016 represent 9.8% of total assets. And so you would go through, and again, you'd set this up in an Excel spreadsheet and use formulas, and bingo, you've got it done. Back in the old days, before Excel existed, and even before the old version of Lotus 123 existed, we had to go and do it the old-fashioned way. Again, why is this important? Well, why do we want to have a common size statement? It's because we can compare different firms of different sizes. So we come up here and we look and we see, okay, this company has $95,298,000 of total assets. How would we compare that to a firm that says has half those assets and half those liabilities? Hard to compare on real dollar terms. But what we can do is we can come down here and we can compare them based on percentages. This kind of tells us a little bit about their operations. And so again, how is this meaningful? Well, in and of itself, just for 1 year, a 1 year window, it doesn't necessarily give us a lot of information, but when we compare it over time, we can see how different mixes are occurring. So look at where it started in 2012. In 2012, cash and cash equivalents was 20% of total assets. It's now down to under 10%. So it's been cut in half in terms of its share, being a share of total assets. Now, that doesn't necessarily relate back to the real dollar amounts, but it is proportional. And so therefore, they're building assets in other places. So where is that happening? Well, the one place you can see it happening is in inventories. Inventories has gone up almost 10%. So it went from being 39.7% of total assets to now 49.4% of total assets. The other thing we can see is that, okay, it's not really going towards property, plant, and equipment because net property and plant and equipment hasn't really changed all that much. It's changed by just over a percentage point. It has kind of vacillated a little bit during the period, but I would consider this to be a relatively stable number. So obviously, the decline in cash seems to be tied closely to the increase in the proportion of inventory that's being built up. The other thing you want to look at is down here the effects on, say, the liabilities, because remember, cash is being used up. So what could you possibly use cash for? Well, cash can be used to purchase things, and so it can be used to pay down debt. So in addition to purchasing inventory or purchasing long-term assets like plant, property, and equipment, it can be used to pay down debt. So you would look at things like your short-term debt. Well, it doesn't appear that we've used much in the way of cash there. Let's look at our long-term debt. Our long-term debt has gone up, and so it looks like we haven't used cash there. And so if I was going to explain in an analysis, what I would be doing is focusing on this because it's pretty significant decline over time. And then I would be comparing it to the inventories because that seems to be the most likely culprit of where the cash is going. The other thing they're not doing is noticing prepaid expenses. Remember, prepaid expenses mean they've shelled out the cash, and so they've taken a liquid asset, cash, and turned it into a less liquid asset, prepaid expenses. So in the past, they seem to have more of a practice of prepaying for things. That has declined in terms of its proportion to the other assets. And so that's also kind of a significant point and may feed into any discussion that you have on cash. So again, if I was going to describe this activity, I would probably describe it as you've got a fairly stable investment in plant, property, equipment, and land. That hasn't changed a whole lot. There's been a slight uptick in equipment from 16.5% to 22.6%. We've also had increases in buildings and leasehold improvements of about just under 5%. And then we have less the accumulated depreciation and amortization. That's been going up as a percentage, which as the asset count climbs, we would expect to see that. And you'd want to see a proportional change in the accumulated depreciation relative to the changes that are occurring in the individual long-term asset accounts. We haven't had changes in the others. Excuse me. So again, when you're doing an analysis on a balance sheet, you don't want to just simply describe, like, I wouldn't want to read an analysis that comes back here and says, well, they had $10,386,000 in cash in 2015, and now they only have $9,333,000 in cash in 2016. That would not be a very interesting analysis. What would be an interesting analysis is that, okay, the company has seen a decline in its cash position by almost, by over $1 million, okay, they've had a reduction in almost $1 million in cash, while at the same time, they've seen a reduction over the last 5 years of cash as a share of total assets from 20% down to 9.8%. And so that's the first part of your analysis. The second part of your analysis is the why. Why is cash on the decline? Why is it down $1 million in 1 year, and why are we seeing this gradual decline of cash and cash equivalents as a share of total assets? And that's when you're going to get into a discussion of, well, what's happening here? Okay, and again, it looks to me like the simplest explanation and the one that I would give you full credit for if you were to answer a question related to what's going on, if you were to pick out that inventory seems to be the key here, that you're increasing the amount of inventory you're holding on to relative to cash that you have on hand. You'd also want to make note that while in total net property, plant, and equipment has been relatively stable, there has been some movement within specific categories. That could be the explanation for why the company is taking on additional long-term debt. Okay, so to go to from 14.9% to 22.1%, that's a jump in the proportion of long-term debt to the rest of the liabilities and equity, and so that may be funding the purchase of additional long-term assets, and that's what you could say about that. So if you wrote up a paragraph or two and included that kind of discussion in your analysis, you're doing great. Okay, if all you're going to do is regurgitate, this went up by this percent, this went down by that percent, that's not what you want to do. I would much rather see you focus in on a couple of areas and tell me something about it, as opposed to just trying to hit every single line item and telling me something that I could easily figure out myself. I want to know that you can critically think about these things. So I've gone over on this particular one, but I think it's important because you are going to be asked to do an analytic or an analysis on a financial statement. And so I think this is going to be worth listening to and coming back to when you get to that assignment as a reminder of what it is you're going to be looking for and what it is you need to focus on when you write it up. So thanks. I will be coming back in a little bit with another recording where we will take a look at that accounts receivable example I talked about, and then hopefully we'll do an inventory and a property, plant, and equipment example as well. And then I want to talk about the taxes area, and so I think I'll do another one on taxes because there's a really neat diagram or figure in the book that will be helpful. So thanks again.